welcome to this week's episode of Macro Mondays. My name is Will Cunliffe, a research analyst here at Onyx Capital Group, filling in for James Brodie, who's away.
I'm Hayden-Briffett, a research analyst here at Onyx Capital Group.
And I'm Spyridon Kokas, a research analyst here at Onyx Capital Group as well.
As usual, we'll be unpacking the key market data, looking at the charts and risks over the previous week and taking a view moving forward. We'll be looking at new highs for gold as China has kept its strategic purchases. We'll be looking at the central banking outlook. We've had a number of big monetary policy decisions this week, so we'll be looking into the outlook there. And we've seen continued record retail buying of US equities, sending indices to all new time highs. But to start, we'll be unpacking some Russian LNG sanctions. So there's been a new sanctions package. Is that right, Spyros?
Yeah, that's right. This is the 19th package of sanctions we had recently. And this time it was nothing about crude oil. Everything was about LNG. And mainly the EU announced that it's going to cut their LNG imports from Russia a year earlier than planned. So they plan to a full ban from 2027 onwards. But you know, the EU has been arguing recently that they've cut a lot of the Russian dependence, saying from 22% in the first quarter of 2021 to just 14% of the second quarter of 2025. But as we saw recently, this is just relative numbers, frankly, and basically their imports have just been cut by 90 million over that the same time frame. So it really doesn't seem like they're cutting their Russian dependence recently. It's more like growing their over-dependence somewhere elsewhere, like the US. What do you think, Ed?
Yeah, it's really a rotation of the supply of the origin, right? So rather than cutting back on Russian imports, what they've done is just increase their total number of imports, which has reduced the proportion of Russian imports. So rather than actually being any kind of impact on how much Russia can sell to Europe, it's more of just a reframing of the narrative. And a major problem has been the LNG ship, seaborne LNG imports rather than pipelines, because we've seen like Nord Stream 2, for example, that's been almost entirely taken out. But seaborne imports have been continuing. And you've also got the Druzhba pipeline, which has been taking oil to like Hungary and Slovakia, which have been staunchly opposed to any more tightening measures on Russia. So there's just this kind of, the rhetoric coming out of the EU is pretty chaotic and inconsistent.
Completely. And as we've seen before, it exposes the European industrial complex to more supply chain risk. You add in a freight component to the price of gas landed in Europe, that will translate to power prices. And, Germany's response to the Russian sanction has been, let's increase our renewable energy capacity. Let's increase our wind gen. Let's increase our solar gen. And that's not good enough. The wind stops blowing, the sun starts shining, they start buying power from France. They don't have the nuclear capacity that France have at all. And they're parking their coal burn, they're parking their gas burn. And so it's no surprise really that the marginal cost of industrial produce from Germany is increasing. And they can't forward plan. It's the same with, in the US, you have a flip-flopping tariff policy from Trump. How can you forward plan if your power prices are going to be super volatile? One day it's going to be negative, the next day it's going to be ripping to 200-300 euros a megawatt hour. It's some cases even high. I mean, in the UK we had a brief episode of power prices over I think over £1,000 a megawatt hour. That's astronomical. And it makes it very difficult to stimulate that industrial complex that has been the life and blood of the broader European macroeconomy for decades.
Yeah, I think also on the sanctions, it's worth noting that this doesn't mean that existing long-term contracts, say they go till 2028, they will remain in place. So again, it's a case of the EU is making this big song and dance of we're cutting off Russian imports, except from this bit and this bit, because they have to complete their contractual obligations. So really, it's like it's the 19th sanction package. If you haven't achieved anything by this point,
exactly.
it's
And
a lost cause.
We saw that in TTF, right? TTF barely budged on the news. So the market's not too worried about this new sanctions package. It's more rhetoric.
Yeah, exactly. And they've consistently emphasized that they cannot even regulate countries like Slovakia and Hungary. They're going to keep buying until, as you said, as the contracts remain in place until 2028. But it's funny that they try to impose sanctions to China or further sanctions to other banks and companies like Rosneft and Gazprom to stop dealing with them. So let's see how this unfolds.
Definitely interesting. So, but moving on, there's been rumored government shutdown in the US. They're struggling to get their fiscal packages in line and get the budget bill passed. Who wants to
so
that, Ed?
the US seems to have this systemic issue at the moment with getting budgets passed through the Senate. So the most recent problem that we're seeing at the moment is that the next spending plan hasn't been approved yet by the Senate. They've got some kind of stopgap that will last until the 21st of November. But the fiscal year starting on the 1st of October, this is only a kind of a band-aid over the amputated leg, really. It's not really going to solve the problem longer term. And one of the main issues is healthcare spending and kind of the bipartisan disagreement over that between Republicans and Democrats. And if you do see this shutdown come into effect, you'll see a massive impact on the economy because nothing can get done, nothing can be approved through the legislation. So you'll see potentially a GDP drag of maybe even 0.1% every week. And the releases of data will be delayed potentially. So you'll have a Fed that's trying to make policy decisions at a crucial moment with delayed or inaccurate data, which has been kind of a theme of the narrative recently as well.
Yeah, for sure. I mean, it seems, as you said, it's a systemic issue in the US at the moment. You have a very polarized political landscape, which doesn't lend itself to an ability to compromise and get bills through. So it's not really too surprising. We also have Trump's fiscal agenda, which is very different from what a lot of the Democrats would hope for. So we'll see how that progresses, but it's not looking too optimistic. But in other US policy, we had a Fed meeting this week, and as largely expected by markets, we got the 25 basis point cut. What was a little bit less expected from markets, I think, was how he struck a little bit more of a hawkish tone this time, actually, especially in comparison to his speech at Jackson Hole, where he indicated a clear pivot in Fed strategy towards the easing cycle. Here he remained a little bit more cautious. He was describing the cut as more of a risk management cut, not any sort of commitment to a prolonged easing cycle. Looking at the dot plot, it does paint a slightly different narrative. So on average, Fed members are expecting 2 more cuts this year. We have certain Fed members, certain new additions who are a little bit more dovish, calling for 125, I think.
Yeah, originally he was saying 150 with the remaining 3 meetings. So he wanted a double cut at each of September, October, December. And that's obviously Miran, who's just been nominated and put in place by Trump.
Yeah, so I'm skeptical of that, but yeah, it definitely seems the committee has a slightly more dovish skew than before. But Powell has stayed pretty dead set that he's open to the new data. Inflation still presents risks to the upside, but the downside risks to the labour market are proving more potent at this point in time. So Powell framed the move as insurance against worsening employment conditions. But the meeting was, as we discussed, messy, and there's no risk-free path from now. So there's dual mandate is in tension, and I think Powell's very aware of that, which is the least risky of the paths. And But the dot plot seen dovish. Rates were seen at 3.6% at the end of 2025. That's down from 3.9% in June, 3.4% in 2026, and 3.1% in 2027. Long run, of course, unchanged at 3%. Growth was nudged a little bit higher in the summary of economic projections. So GDP is now 1.6% in 2025 expected, 1.8% in 2026. Inflation remains sticky though, so they're still penciling in 3% in 2025, which will cool a little bit to 2.6% in 2026 in their projections. Unemployment is expected to remain steady at 4.5% before dipping. So, we do have relatively low unemployment. We have relatively high inflation, that's a percent above target. Yet the Fed is still pivoting to focus more on employment. What's your thoughts on that, Spiros?
As you said, they have the dual mandate, and as we also saw, they even project the 2027 inflation to be just above the 2% target. So basically, they're gonna fail on at least partly on their mandate for 7 years, if projects are to go as planned. But the labor market uncertainty, I think that's what we all should be looking at right now. Labor force participation has been constantly declining recently. So on me, I'm slightly on the dovish side. I would like to, I'm a bit more cautious on the 4.5% unemployment, just because we see more people going to retirement and not actively seeking for jobs. So that's still another issue that the Fed has to probably consider about.
And, I think it's also important remembering where we are in the easing cycle. With rates at 4 to 4.25, they're still on the slightly restrictive side. Historically, labour markets, they move with momentum in both directions. So if we start to see the slowing continue, that's only going to accelerate further if Fed doesn't adjust its policy stance. So I think, completely agree with you. I think the Fed is going to be taking a more dovish stance, especially after the big NFP revisions we've seen. And I wouldn't say that that's due to political pressure. I know a lot of people will be saying, the Fed is bending to Trump's pressure. I wouldn't see it as that. I think there's been a material worsening in the data which has informed their judgment, and they're now considering a change of course. And that's what we're starting to see. And that's, that we've seen the dollar soften considerably over the past month or so, as the market has gone from pricing, barely 2 cuts this year to almost 3 now. So we've seen a big move in the OIS. But immediately after the meeting, we saw the dollar bounce a little bit. But I don't think that the dollar is going to be moving too far outside of this downtrend. I think that's going to be continuing further. I mean, if we look at the next slide, one kind of clear indicator of what market cycle we're in is the 2s, 5s, 10s butterfly. And we've seen that detach from the dollar. So when the 2s, 5s, 10s rallies, we tend to see that as a bear cycle indicator for the dollar. We've seen a steepening down the curve. So the 2s, 10s has steepened pretty aggressively this month, off the expectation of further Fed cuts. And in the belly, this is where we see the market pricing the transition. So from Fed cuts back to neutrality. So this is where the market is expecting the Fed to pause its easing cycle or even pivot towards hiking again. So traders expect short rates to fall quickly, but they're not expected to stay low and depressed forever. So this is what's pulling the 5-year up relative to the 2s. And that's what we're seeing here in the 2s, 5s, 10s butterfly. You can always think of the belly as like the policy path maturity. So the divergence here really, to me, is a bearish indicator for the dollar. What do you guys think?
I think, I mean, you say that the dollar bounced a little bit from its FOMC low, and that's true. But when you zoom out, the big picture is still very much this consistent downtrend, as you can see on the chart. We're even beginning to creep a bit lower from that consolidation period that we saw over the summer months. So I think there is certainly still some downside there. However, it depends, I think, really on the next FOMC and the next kind of indications you get from the Fed. Definitely. If they suggest that, that kind of insurance cut that they just made was just in case, and then they could pause and reassess and then think maybe about cutting again into next year, then we could see perhaps a recovery. But I think they are going to make at least one more cut this year.
I think they have to. I think the improvement in the data that would be necessary for them to take a pause at this point, or for the market to not price cuts. So if the market's pricing 70 basis points of cuts this year, we'd have to see such a material improvement in the data for them to reverse that. And the Fed does not want to shock the markets too much. They don't want to be completely at the whim of the market, but they will want to avoid shocking the market for sure. So I foresee another 2 cuts as things stand at the moment this year.
I agree. And I think, as you said, the Fed doesn't want to disappoint right now. 2 cuts is the most feasible path towards the year end. So
And I mean, another point of disappointment, I suppose, in the US has been the housing market, hasn't it? Housing starts have been pretty soft.
Yeah, I mean, you've got at this point, 5 months of consistent declines, and that's the most consistent continuous declines since the financial crisis. And when you're looking at housing and you're making a comparison that this is the worst it's been since 2008, that's already a very bad foot to be starting on. So this is also obviously not good news for kind of energy demand and overall construction, because if you've got less housing demand, you've got less construction of housing, that will then have a knock-on effect to all the other industries involved in the construction process. So it is kind of people refer to a mortgage as perhaps the bedrock of the financial system. And if you've got the lack of housing starts, then that's going to hurt mortgages, hurt construction, hurt all these sectors that are dependent upon housing.
Yeah, I mean, it's interesting. I mean, so here in the data, US housing starts fell 8.5% month on month to 1.31 million annualized. And that's the weakest since May and well below the 1.37 million expected. That's down 5.8% year on year. Single family starts were down 7% to a 1-year low of 890k, while multifamily were down nearly 12% to a 3-month low. These are pretty dire numbers. But on the other hand, we are starting to see mortgage rates come off. So mortgage rates fell to 6.39%, which was the lowest in a year. And we've seen mortgage activity, so mortgage applications, pick up a little bit to a 3-year high. So, I mean, that's going to encourage, obviously, demand for property, demand for real estate. So perhaps we're seeing a bottom in the housing starts. If the Fed does embark on an easing cycle, if we don't see a dramatic repricing of the 10-year yield, then that should start to come down as well with the rest of the curve. So for me, what I'd be watching is how does the market react to the fiscal situation in the US? Does Trump get his big, beautiful bill? And what does that mean for issuance? Because at the moment, the 10-year is going to, we've seen credit default swaps on the 10-year treasury are pricing the same as the 10-year CGB. So that there's definitely an element of risk being priced into that 10-year yield. And that could prop up mortgage rates if that continues or worsens. But in an easing cycle, they tend to come down. So that could help. So we could be seeing a bottom of the housing softness, I guess. But back to commodities, if we take a look at gold now. So gold is making new all-time high after new all-time high at the moment. We're at $3,720 per ounce. and the gold to silver ratio is falling back towards 85. So I mean, yeah, it looks like it's a good time to be bullish gold.
It's been the headline. It's been the headline of every single week recently, if I'm not mistaken. So we've seen that consistently. We've seen major central banks emphasizing on increasing the gold reserves, and I think, I don't know if you agree, I think there's still some more upward room, but not as much as we've seen recently.
Yeah, I mean, it's gone from as well seeing some headlines of like banks forecasting $4,000 to suddenly banks forecasting 5,000 within the last week or so.
Yeah.
And I mean, it shows that there is still definitely that appetite for gold, and there is that belief in its upside potential. And I think if you do continue to see the central bank buying that we have, but I think there is still belief in the upside potential for gold, and part of that is due to the purchasing power, which has been steadily and consistently declining in terms of how much you can get for your dollar. So if this goes back to the kind of the inflation hedge aspect of precious metals, then you can see that like now we're at what, $58 for $100 worth back in 2000. So you've lost nearly half of your purchasing power. And I mean, clearly this doesn't tell the whole story because gold's up by what, 40% in the last year. So this is part of it, but there is also much more going on as well.
Yeah, I mean, you have, dollar debasement rhetoric. You have a Fed that is prioritizing the labor market, downside risk to the labor market over its upside risk to inflation. So inherently there, that means they're more tolerant of a higher inflation rate above target. So yeah, I mean, it's no surprise people are rushing to these kind of hard commodities like copper, gold, and silver. We've seen, precious metals have been doing pretty well across the board. I mean, palladium as well. So I think that's not too surprising, especially if you add in central bank buying like China, India have been buying, Poland have been buying.
Poland's bought a lot, yeah.
So there's a lot of force behind this rally, I guess. What do you think would be the catalyst to see it correct lower?
I think you'd have to see a large repricing of sovereign debt, a bit more confidence in the bond market, because I think that's been partly the safe haven kind of flow has been diverted pretty much entirely towards gold and precious metals rather than towards the bond market, where you've seen, and I've got a chart later on as well, which will show the impact on bond yields, but the long tenors of US treasuries, UK gilts, French oats, bunds, they've all been rising because of these fiscal sustainability questions and the threat of inflation. And I think gold has really benefited from that. So if you can see that narrative flip on its head, then you could see a downward correction. But I don't see that happening yet.
Yeah, it's interesting, isn't it, as well? Because typically, gold would be a favorite in a risk-off environment. But it doesn't feel like a risk-off environment at all at the moment. Equities are doing very well. It feels like the market's putting on decent risk. At the same time, you have gold now correlated with other risk assets. So it's an interesting landscape, that's for sure. Tough one to trade, I imagine. But onto fiscal sustainability, Trump has been for a long time touting the trillions of dollars that tariffs are going to earn the US Treasury. But it doesn't look that way, does it? I mean, deficit was near 345 billion in August, while we had about 30 billion in revenue from tariffs.
Yeah, and over the longer term as well, since April, so since the Liberation Day, since the tariffs were introduced, only 18.4% of the deficit is covered by tariff revenue.
Yeah,
and that's that's a tiny amount, but partly because of the fiscal sustainability problem, the US's addiction to spending too much, and also just partly because the tariffs haven't delivered on the promise that Trump was obviously giving that they would solve the whole economic situation in the US, and it's just completely failed, like everyone predicted.
Fiscal policy 101 is the Laffer curve. If you tax people too much, they will stop doing it. So you'll generate less revenue. That being said, the tariffs have generated more customs duty revenue than the same period last year. Last year, it was typically around $7 billion a month on fiscal revenue from customs duties. This year, after the tariffs, it's been more like 30. So it has seen a material increase in revenues, but at what cost? I think most people would agree it's a pretty regressive approach to economic policy. So I mean, here if we look, tariff revenues have clearly increased as seen on the chart. They're now about 1/5 of tax receipts. That's up from just under 5%. So it's making a difference. It's not trillions of dollars.
It's making a difference, but it's failing to have the impact that was promised and expected. I think the main impact has been on the other aspects, the confidence in the US, the actual activity with the US. So like trade, for example, that's been so choppy in the last 5 months, purely because people are trying to like second guess. Do I have to pay tariff if I import then, or how much is it for this product, this resource? So if you look on the next slide, we've got the CAS freight index, which has fallen to its lowest since COVID and the financial crisis. So this is shipments to the US have just been plummeting, and that is largely, I think, due to the tariff situation.
Yeah, of course, and you've got to remember that there was a huge front loading of shipments before the tariffs came into place. Inventories were built, and they're starting to be unwound as tariffs are in place. I think a lot of enterprise in the US is hoping for tariffs to be a fleeting policy addition, and I think they could be right. I think I think Trump himself probably wants to unwind the tariffs after he has reached some sort of diplomatic wins.
Yeah, well, we've seen that with India as well.
Exactly.
Like they've recently been making some more kind of positive noises that we're hopefully in a few weeks going to have a deal. We've heard that for a lot of weeks now, but there is definitely that appetite to actually improve the situation.
Definitely. So then if we look back at the Chinese non-monetary gold imports, so China's non-monetary gold imports jumped 64% month on month in July, or 104 tons, the second highest reading this year. I mean, this is demand from households, jewelers, private investors. This is not central bank buying. What do you think that reflects a more risk-loving Chinese investor? How would you read this? We've said that gold is behaving a little bit more as a risk asset at the moment. Do you think that's true in China, or do you think they're looking for a new source of savings?
Yeah, of course. I mean, I think I also see it as part of a transition. Switzerland is a major gold exporter, and we've seen recently the exports of gold to the US have plummeted. They're almost zero right now.
Yeah.
And you saw a big uptick to China, and that partly explains the reason. We've seen Chinese appetite keeps increasing. Precious metals are always good inflation hedge and uncertainty hedge, as we've consistently emphasized. And could be possibly a seasonal uptick. But as we also mentioned, the PBOC has consistently increasing, I think, for the 10th consecutive month now, their gold purchases. So
I think it's also, the Chinese investor wants to allocate their wealth somewhere. They want to put their money to work. We've seen them invest more heavily in the stock market recently, pretty aggressively actually, the retail uptake in Chinese equities. They don't want to put it into housing. No. Housing is still underperforming in China. It still remains a key source of weakness for the economy structurally there. So if you wanted a more risk-averse component in your portfolio to maybe offset these very volatile Chinese tech equities, why not allocate in gold? I think that's probably a lot of the reason. But so housing's clearly bad in China, but investment has also been quite bad. We've seen new yuan loans, they've been soft, and Chinese FDI has been negative every month since May 2023. At the same time, we've had the PBOC on an easing cycle. So what do you think is going to trigger a more risk-loving and a little bit more credit appetite in Chinese economy?
I think first of all, credibility. We've seen any new data releases or any conferences we've seen from presidency. They've been released months later than when they happened, like the one regarding the outstanding local government debt. That was a big issue that it was raised in February, but got released in August. So investors definitely want to put their money when they know what's the outlook. But I think China has placed a lot of emphasis on internationalizing its market. Taiwan, right now, they've trying to bring some more investors. So let's see how this can play over the next few months, because although it's negative, it's slightly trying to...
Right.
It's not as bad as it was.
It's not as bad as it was, we can say.
It's trying to come back. Yeah, no, for sure. And we'll start to see that kind of that base effect work in FDI's favor here as well. I think, you're definitely right from a strategic point of view. China want to diversify their export portfolio. They want to trade with a wider range of partners. They want to be less reliant on the US. And part of that will be encouraging FDI. I think they'll look for strategic partners, perhaps Russia, to provide some FDI. They'll also be looking to invest elsewhere. And that could include some bilateral agreements, some bilateral deals. So it'll be interesting to see how this unfolds. I think really liquidity needs to be improved and confidence needs to be improved, as you say.
Yeah.
I think that's the key focus for the CCP and for the PBOC. But moving on to Japanese inflation and the Bank of Japan. So Japanese CPI slowed to 2.7 in August. That's the lowest since October 2024. So perhaps we can't be so hawkish, BOJ.
Yeah, that's the main question. But we also saw food inflation was at 7.2%. So this is a big concern for the Bank of Japan. We also even saw the governor emphasizing on that point, that even though they held rates at 0.5%, this is a big risk, accompanied by the tariffs and the fiscal stimulus concerns that we might see from the new government. So everything is in play right now. And I think it's fair to say maybe another interest rate hike would be priced in by the year end, but there's high possibility for that.
Yeah.
But the most concerning right now is that the Bank of Japan is one of the largest stock investors in the Japanese stock market. So the ETF purchases are something over 530 billion US dollars. Yeah. So that's about more or less 7% of the total Japanese stock market.
Yeah.
And they said they would start unwinding their ETFs as part of the quantitative tightening. But that's going to be a tiny portion. That's about 4 billion per year, just so they can control the market and see where this can go. But if we were to annualize that needs over 100 years if they want to completely offload the balance sheet. So, yeah.
Interesting. But then back over in the UK, we also had a monetary policy decision there. Bank of England, they kept rates unchanged at 4%. But they did announce that they're going to slow QT. So, QT has been a big deal at the bank, I think. It's been a clear focus for Governor Bailey. They originally were targeting £100 billion worth of unwind. Now they've moderated that to 70 billion. I think QE has faced a lot of criticism in the media. And rightly so. I mean, I think most people would agree it was a largely failed initiative when we were stuck at the zero lower bound, and will now necessitate an element of QT. That's not going to be good for Rachel Reeves and her upcoming budget. Any sort of view that the new budget is on the more fiscally liberal side, combined with continued quantitative tightening, we could see gilt yields shoot up pretty hard. And yeah, that's not good for Reeves. I mean, what do you guys think?
Yeah, well, I mean, we referenced it a bit earlier that the yields are just rising consistently. Like the UK's 30-year is the highest of any G7 member.
Yeah.
And, you know, the public spending is just rising. It's up by nearly 37 billion year on year. Debt interest was 8.4 billion pounds in August alone. Yeah. So any hope of kind of a fiscally liberal budget is dependent upon the yield. And I think, frankly, there is enough room for Reeves to come out with any kind of significant spending plan.
I think it's going to be a painful budget. I mean, last budget we saw them kind of teasing the market a little bit with number of leaks that were, big hikes, big tax hikes, basically.
Yeah.
And then they didn't follow through, probably kind of trying to do a bit of damage control before the fact there. So maybe we'll see a little bit of that going into the budget this time around. But I think, what I would be concerned about is let's say Reeves has to be replaced because yields rally too high, the budget's considered fiscally irresponsible. Who comes in next? I mean, I think Reeves is probably the most fiscally conservative of the Labour Party at the moment. I'd be very concerned.
It's actually very concerning. They don't seem to have forward-looking outlook. It's very short-term looking. They need to raise money somehow. We see
or cut spending. I think really
balance.
They need to cut spending.
To cut spending, yes, but we haven't seen any progress on that or any efforts to progress in the near future.
No, I mean, but there was the PIP bill. They tried to kind of reduce spending on PIP and certain portions of the welfare state, which was blocked by backbenchers.
I think the problem is that any cut to spending will be so politically unpopular, it becomes impossible to actually pass. So the only alternative is to increase income. And the only way of doing that really is by issuing debt or hiking taxes.
Yeah.
And hiking taxes, again, you've got political lack of popularity.
Yeah.
So debt, and then you've got the bond yield problem, which really puts you in a real catch-22 situation.
Yeah, I mean, we've got yields, higher than they were at the Trust mini budget.
Yeah.
So it seems like we're on a bit of a precipice here, and I can't imagine that the budget is going to inspire much confidence.
No.
But back to commodities, we'll take a look at Brent now. So Brent has been, a little bit more range bound. We've kind of bounced off that 66.50 floor. Now we're trading at around $67 a barrel. I mean, where do you guys see it going from here?
It's hard to say. It's hard to say. Last week we pointed out to China that they could potentially increase their purchasing if they see this mini floor, as we said. But I don't see any room going any more upwards. At least last week it fell really hard to even break above 67.50, and unless any big news come out, I'll see probably around the $67 mark.
Even when you mention big news, I think the market is quite headline fatigued still.
Definitely,
The summer holiday period is dissipating. You have seen a pickup a bit in volatility and actual volumes traded, but it still feels fairly quiet. I think end of September, beginning of October, it will pick up again a bit further. But I think it would need a jolt one way or the other. I think upside is more likely than downside, though, personally.
Yeah.
I think that we've got a pretty solid floor there in the mid-60s. But also, I'm skeptical we'll be able to get above 70 because that's where I think China's buying would just back off and say, no, it's a bit too expensive. Let's reduce our purchases.
It's true. I mean, China, they tend to buy below 70, really.
Exactly.
But what we've seen is for a while, the arb from the North Sea into China was closed. Freight was too expensive. But we're starting to see 40s and some of those North Sea grades open up into Asia. So, and the closure of that arb really was a source of pretty phenomenal strength in Dubai. And we're starting to see that Brent Dubai differential close as 40s clears into Asia. So we should see that normalize a little bit, which to me kind of makes me a little bit bullish Brent.
I think the one offsetting factor to that is freight, because freight costs for shipping are still incredibly high.
They are.
VLCC daily cost is getting near to $100,000 per day. So that's really going to limit the potential upside there. So if you do see a freight reduction, I think then you could see much more of that Brent Dubai, the bullish Brent Dubai kind of narrative coming through.
Definitely. Especially as you have to load North Sea crude with unsanctioned vessels.
Yes.
The same isn't true for Iran crude. So, yeah, I think, similar to you guys, we're going to probably see a bit of a range-bound flat price action. But I think the spreads will be interesting as well. And I think the physical differentials in the North Sea are going to probably normalize. They've been very weak recently. And as that arb opens, they should normalize a little bit, which should support time spread structure at the prompt in the futures. So
in some way, the inverse in Dubai as well.
Exactly.
That has been propped up, as you said. That's already coming down.
Just this morning, physical premiums around $2 when they have been up near 3 only last week. So, there's going to be a little bit of a kind of an east-west normalization is our take at least. But over to equities, S&P made new all-time highs again. So we're seeing, similarly to gold, repeated all-time highs in the equity market in the US. Every time this happens, we'll repeat that ratios are blown out. It seems unsustainable, but then we'll be back next week with another all-time high. So, I mean, what do you guys make of it? Where do you think this can continue?
I mean, it could possibly continue. You could see some further strengthening. It's everything tech weighted right now.
Yeah.
But as we have here on the chart, it's mostly what foreign investors perceive, which we see in dollar terms or euro terms, that's even below the same level as pre-liberation day or even below January levels. So that comes back to the point of the dollar weakening we're saying, and basically the risk that no foreign investor wants to have in the dollar. We've seen hedging activity being elevated recently, just because everyone wants to lock their dollar risk. And I don't see this. I don't see any near-term change unless the political situation in the US slightly moderates.
Yeah, well, you mentioned the tech-driven rally, and that's been hurt, I think, over the weekend by the sudden proclamation that H-1B visas for the US will now carry a $100,000 application fee. As it turns out, that's not an annual fee. That's only for new applicants. That's not for existing applicants, but it's caused absolute chaos among particularly tech companies. But this morning, they don't seem to have reacted in pre-market trading. The Metas, the Microsofts, etc., they have held fairly steady. So maybe the market will kind of discount that kind of political shenanigans and see what happens when it is almost inevitably challenged in court.
I think you also gain an element of insulation, even though the index is obviously highly weighted towards your tech companies. If you're buying the index, I don't know if retail are really thinking about how concentrated that index is. And I think this is really a flow story. We've seen pretty consistent capital inflows into the S&P 500, the NASDAQ, and I think that's been supportive. If we start to see those inflows turn to outflows, I'd start to be concerned then. But for now, it seems like they're pretty consistent. That's where people want to put their savings. Before it would have been bonds, but we've seen appetite for bonds
plummet. Frankly.
Exactly. Everyone's taking the 401k approach now and investing in US equities. So I think this could have further to run.
Yeah.
But given the correct catalyst, we could see pretty aggressive corrections as well. So
yeah, that's why we're also seeing the next slide, the retail slide, basically.
Yes.
As you mentioned, it's I think up for the week, the highest, one of the best performing weeks in terms of volumes from retail investors, right?
yeah, I mean, if you look at Goldman's retail favorites basket, which is a basket of stocks that are particularly favored by the retail segment of the market, they've been up for 10 straight days of gains, and they've been up 13% over those gains. That's driven by retail money. And retail they tend to hold on through the volatility. They won't de-risk with a bit of volatility. They'll keep invested. They'll stay long.
By the dip.
And if not average down,
Yeah.
Exactly. I think for now US equities remain in the uptrend.
Yeah.
So to wrap up, we'll run through central bank OIS pricing as well. So the Fed is now pricing just over 100 bips of cuts over the next 12 months. The ECB only 9 basis points of
I
cuts
think
from
that
the
will have to
ECB.
come up to another cut.
I mean, we're towards the back of the horizon. We're actually seeing hikes start to be priced. So it'll be interesting to see how that unwinds. Bank of England at 37 basis points of cuts. The RBNZ at 69 basis points of cuts. Bank of Australia at 43. Canada at 38. And the Bank of Japan at almost 50 bips of hikes. So, looks like the market's gearing up for a more aggressive hiking cycle in Japan. Be interesting to see how the yen fares in that environment. Do we see another reverse carry trades crisis as we've seen in the past? But we'll see. Key data this week. On Monday, we'll have Euro area consumer confidence, as well as Fed Mirren is speaking.
Well, that will be something everybody, I think, will be monitoring because he's the new governor that Trump elected. And as we said, he called for what?
150 bips of cut this year.
Yeah. So I think not many people will be concerned about the how much he's gonna price for cuts, but the tone will be something really important.
Yeah, I mean, if he's smart, I think he'll probably refrain from giving an actual number of cuts. But given how close the dot plot was, but yeah, it'll be interesting to see if he comes out mega dovish again. I think he probably will in an attempt to appease Trump. And then on Tuesday we have PMIs across US, India, Euro area and the UK, as well as Powell will be speaking. On Wednesday, we have more US housing data with US new home sales, as well as Japanese PMIs.
And then Thursday, it's German and French consumer confidence, US durable goods sales, final GDP assessment, and existing home sales. And finally on Friday, we've got Tokyo CPI, France unemployment claims, and US PCE, which will be quite an important one, I think, indicating Fed direction over the next couple of FOMCs.
Yeah, for sure. Anything standing out there to you guys that you're going to be particularly paying close attention to?
I think this is a data-heavy week. Particularly importance will probably be placed on Tuesday, where we have all these PMIs among the stronger economies, and as well as Chair Powell's speech, which is something we need to see what the tone is. We need to see how the Federal Reserve is thinking right now, and if the next 2 more meetings will be cut. We know for sure there's going to be more and more cut, but we need to see if it's going to be 3 this year. What about you, Ed?
Yeah, I agree. I think it's the kind of the tone that you'll get from the Powell speech more than Moran, because we kind of know going into it what he's going to say, and then followed up with the PCE. I think those two combined will be the key factor.
For sure. I think PCE is going to be a key bit of data. I'll also be looking at the final GDP release, seeing, do we have any big revisions there? Because if we have, the BLS and the BEA's recent track record as anything to stand by, could be a big revision. So yeah, data heavy week. Stay tuned for daily updates on LinkedIn from Onyx Institute, where we'll be providing a rundown of the data as it comes out each morning. And thanks for watching. See you again next week.